Good morning all, and welcome to the session for today. How are you guys doing?
Fine.
Oh, we are well.
We are fine.
We're fine.
All right, thank you very, very much, everyone. And my apology for invitation for a class on a very short notice. I wanted things to move quickly in terms of coverage. And so I had to make that, could I call it emergency decision, yeah? So thank you very much for your availability, and welcome to this session, within which I will discuss the statement of cash flow. It's a discussion which of course already you've had before in financial accounting and financial reporting, yeah? We shall not start this from scratch. Rather, business data analytics concern is whether given information about an entity, you are then able to prepare one, yeah? And so what I've done is to share with you a format for the statement. So what is most important will be to look at a question which, based on we then illustrate how the statement of cash flow is normally prepared, yeah? Now, just in a brief, when you look at the format which I have sent you, and by the way, this is the format based on the indirect method, yeah? There are normally two methods of preparing this. One is the direct. Number two is the indirect. Then I will always advise that stick to the indirect approach for ease of really preparing this, yeah? The direct approach is complicated, and so its usability, especially for exams, I do not recommend, yeah? The approach which is common, and of course this is now common for your examination purposes, then become this that we call the indirect. And so when you look at the format, you realize that the statement of cash flow classify cash flows into three categories, yeah? One is this which we call the operating cash flows, followed by the other category that we call the investing cash flows, and then the last category is what we call the financing cash flows. And so what the statement of cash flows does, yeah, is to then summarize all cash flows of an entity into those three categories, so that any money either received or the converse money spent, that will be classified into one of these three categories. And so as a summary and in brief, all cash flows are therefore into those three categories. I do not want to explain this much, because I know you are well conversant with the preparation of this, yeah? what is most important for us is to then illustrate how this is then done. On that note, we shall proceed to look at a practical example. And in this case, we shall refer to the December 2022 exam question number 24. So December 2022 question number 24. So please very quickly refer to that question so that we could proceed to illustrate this. Yeah. All right. Proceed to that question and read through it. So I think I'll give you maybe 2 to 3 minutes. You read through that information first. Okay. All right, so let me hope you have read through the question, and so we can proceed. The first thing that I want you guys to note is that the questions for a statement of cash flow will normally be set in the same manner. In terms of a question will provide information, including three types of information, including one, you will have an income statement, and you don't need to write this. Number two, there will be balance sheets. There will be balance sheets, and the balance sheets, you will have two of them. And then thirdly, there will be additional info. Now, the income statement you will be given for the current year, the income statement has to be for the current year. And then, of course, for the balance sheets, you will have two. One is for the current year, and also you will be given for the prior years. So this is the kind of info that in all questions for a cash flow statement, you will always come across, yeah? And so the first thing to do is to deal with the additional info, whereby adjust the additional info appropriately. By, of course, having such adjustments, we shall be working out various cash flows, which we then require for the statement of cash flow, yeah? So what we shall start with are therefore the workings. And so we'll start with number one. So in that respect, we can start with note number one. We can look at note number one and see what we are told in a note one, so that appropriately thereafter make adjustments for what we should, yeah? When you look at note number one, we are told that property, plant and equipment held by Bermuda Limited are items of plant and equipment and freehold premises. Now, during the year ended 30th June 2022, items of plant and equipment which originally cost 40 million were disposed of, resulting in a loss of 6 million shillings charged in administrative expenses. So in that case, we have two things to note. Number one is that, and if this is not given directly, you have to compute it, is that we have a loss, on disposal. So remember, when you dispose or sell an item of PPE, we do get a profit or loss on such sale. So I am saying that if this is not provided directly, we are fortunate in this question that we have been given this, but if this is not provided directly, then you have to compute it. And so the question is clear that in this respect, we have 6 million. So we have to note that for a simple reason that the loss or gain on disposal on assets is normally adjusted for under the operating cash flows. So later, under the operating cash flows, we shall adjust for it. For those who have forgotten for how we adjust for it, you can refer to the format which I sent earlier. Now, the second thing to note, number 2, when you dispose an item of PPE, then you must adjust for the disposal within the PPE account. So the next working that I will have here is the account for PPE. The next working that I will have is the account for PPE, and so I will prepare one. So I am preparing the PPE account. And so I'll say that this is a property, comma, plant and equipment, and equipment account. Yeah, so that being an asset account, we have to remember that it's a debit account, yeah? And so the balance brought forward for it, we debit. And that brought forward balance, we should compare, yeah, with the balance carried forward. Then on the credit side, yeah. So remember, it's for this reason that we have two balance sheets, one to give us the opening balances and another to give us the closing balances, yeah. The current year's balance sheet gives us the closing balances, and therefore the carried forward figures are the figures under the balance sheet for the year 2022. The opening balances will be balances in the balance sheet for last year. And so those are the balances under the year to 2021. So in that respect, we shall have the balances. All right. How much is the brought forward figure for the PPE account? Look at the balance sheet for the year to 2021. How much is it? So that we are together, could I have this from one of you?
264 million.
Yeah, that is 264 million. Thank you. And so the figure under the year to 2022 is the closing balance 327. 327. All right. Note number 1 says that we have disposal. And disposal normally means that you decrease the asset account. So in this case, we shall decrease PPE. And so what we shall do, you know, being an asset, it's a debit. To decrease it, you credit. And so on the credit, I will say that we have disposal. I will say that we have disposal. Remember, we shall record the disposal at what? The net book value, because the figures for PPE, we have been given them at net book value. Now, what was the net book value of the asset we disposed? Go back to note number 1. Go back to note number 1. We are told that the net book value for it at the time of disposal, we had how much? The net book value for it at the time of disposal, how much was it? Somebody.
28 million.
That was 28 million. So that was 28 million. And so what else do we calculate as far as note number 1 is then concerned? Yeah. So leave alone the account for PPE for now. Let's close it off a little later. Yeah. Let's go to working number 3. So one more thing you have to remember is that when an asset is sold or when an asset is disposed, we do receive cash from disposal. Yeah. And so because the statement of cash flow is concerned about cash, then we have to compute the cash from sale. The next working with respect to the disposal is therefore how much is the cash from asset what? Asset disposal. And this we shall compute based on the disposal info. The question is very clear that the asset disposed had a book value of 28. At the time we disposed it, the book value was 28. And then remember we disposed at a loss of 6. In terms of how much cash we received, what figure are we talking about here? Somebody?
22 million.
Yeah, that's 22 million. So you have to note that later, the 22 million will be considered an investing. The 22 million will be considered an investing cash flow. Yeah, for those not used to online classes, if you don't mute, you disturb the whole class. Like somebody now has refused to mute. Yeah. Please learn to mute so that you don't interfere with the whole class. Yeah. All right. So any cash that you receive from asset sale, those are normally investing cash flows. And so later in the statement of cash flow, we'll say that we have cash from disposal 22. Now that is investing. Let me proceed to the fourth thing to note. And the fourth thing to note will be note number 2. When you look at note number 2, we are told that depreciation charge for this year amounted to 43 million. So that's also needed for the statement of cash flow. And so I'll say that we have depreciation, expense, which again, remember, if a question does not provide directly, like this has been provided here, yeah, then you must compute it. You must work it out, because later in the statement of cash flow, this will also be an operating. This will also be adjusted for under the operating cash flows. So that will also be adjusted for under the operating cash flows. So at the same point that we shall adjust for the loss on disposal as an operating cash flow, we shall also adjust for the depreciation expenditure. Remember, as what in the statement of cash flow we call the non-cash items. But again, you have to note that depreciation is normally on what? The property, plant, and equipment, whose account we are preparing in this working number 2. When that's the position, then of course we have to remember that depreciation decreases PPE, and so we need to credit PPE account to decrease them, and say that we have depreciation. This is 43. That's 43. So that's 43. Now, when I look at note number 3, that is now in the question paper, yeah, I do not see anything else that relates to the PPE account. And that means technically we should balance off the PPE account. But then before that, I want us to refer to there is something to do with the revaluation reserve, yeah? Go to the balance sheet. And please look at under equity. There is something to do with the revaluation reserve. And between year start and year end, what has happened to the revaluation reserve? Has it increased or has it decreased? Somebody.
Has increased.
It has increased. Are you sure?
It is indeed decreased.
Between year start and year end, yeah? Is it increasing or decreasing?
Decreased from 67 to 36.
Yeah, so that's a decrease. At the start of the year, you had, please look at the two balance sheets carefully. Know which one starts and which one ends the year, yeah? So that this has decreased from 67 to 36. Now, could somebody remind us of why would the revaluation reserve decrease? What normally makes it to decrease? Let me hear from somebody. What would make the revaluation reserve decrease? Anyone? Yes, anyone? What would make the revaluation reserve decrease?
Disposals?
Disposals. All right, yeah, that's when the asset disposed is the one that also had revaluation, in which case a question should be very clear, yeah? What else?
If any item of the PPE has lost value.
Anytime the PPE has lost value, yeah? Now, this is what I want to hear, but what is the right terminology for it? What makes a revaluation reserve decrease? When in the current impairment. Okay. Yeah, so again, when an asset revalued is impaired, you write off the revaluation reserve by whatever impairment, yeah? So that's okay. Again, in which case you should be told very clearly, yeah? What is the most obvious here? The most obvious thing here would be if in the current year, the asset has been revalued, and then you have experienced what we call a revaluation deficit. So that a Fantas says in the chart that revaluations in the year. So a Fantas, that's right. Because if in the current year the asset has been revalued, you have two possibilities, that either you have increased the asset in value or you have decreased it. Now, when you have increased the asset in value, that is what we call a revaluation what? Surplus. And then when you have decreased the asset in value, that's what you call a revaluation what? Deficit. A surplus will mean that you increase the asset in value, and similarly, you increase the related revaluation reserve account. And so in the case of a deficit, then the vice versa will apply, that you decrease the asset in value, and similarly, you decrease the related revaluation what? Reserve. This is what we are noticing. Remember for this question, that the revaluation reserve decreased by so much. And that means that consequently, the PPE also decreased by that decrease in that reserve. Remember that to decrease PPE, we've said that credit, and in this case, we shall narrate that this is revaluation. This is revaluation deficit for the year. And how much is that decrease? How much is that decrease? Somebody? The decrease in that revaluation reserve, how
31.
much?
31 million.
31 million, yeah? So we work with 31. So that is decreased from 67, remember, to 36. So consequently, we also decrease PPE by that 31. With that, I want to believe that we do not have anything else that then affect the PPE account. And if that is the case, then we can balance off the PPE account, yeah? Let's balance off that account in terms of find out which of the two sides is more, and then by how much. This looks like the credit side is more. So in Excel, that should be easy to do. The credit side is more at 429. And so the debit side should also have 429. If that is the case, you know what we are looking for is then the balancing figure. By how much is the credit more than debit? So this is what we are looking for. And you know, we have to then ask ourselves that what is this balancing figure? What is this balancing figure for the PPE account? What is this balancing figure for the PPE account?
It's acquisitions.
Yeah, so thank you very much. That's absolutely correct. Now, remember that this is appearing on the debit of the PPE account. The PPE being an asset and being a debit balance, anything appearing on the debit is something that increases it. In respect of the statement of cash flow, unless you are told otherwise, then this 165 will be a cash acquisition. So that is there for the PPE that we acquired in what? In cash. And most important will be assets which are acquired in cash, or cash acquisition of assets will be classified under the investing. Later in the statement of cash flows, this we shall classify under the investing cash flows. So later for the investing cash flows, we'll say that we have this 165. All right. So the sole purpose for therefore preparing this account for the PPE, remember I saw that we get the value of this cash purchase, because that will then appear later in our statement of cash flow. So unless somebody has a question, then I'll proceed on to the fifth thing to note. The fifth working. And we can have this with respect to additional information number 3. So that when you go to note number 3, so note number 3 in the question paper, we are told that 50 million shillings of convertible loan stock was converted to 50 million shillings of ordinary share capital, we are told that at par, that is during the current year. When you convert a loan to ordinary share capital, what happens? Can we first of all note that look for the loan stock? Look for the loan stock, and that was under the non-current liabilities. Under the non-current liabilities, we have 10% convertible loan stock. At the start of the year, we had 150. At the end of the year, we have 100 million. Note that we have a decrease, and that decrease is by 50 million. The decrease of 50 million is what is being talked about in that note number 3. That decrease of 50 million was because of converting partially the 10% loan into what we are told is ordinary share capital. In that case, we will agree that when you convert a loan into shares, then you decrease the loan, and that's what is evident in that balance sheet. Remember, conversely, it's more like you've issued shares. So conversely, you increase the share capital. The account which I want us to look at is the ordinary share capital account. And so I will prepare one so that this is ordinary. This is ordinary shares account. Ordinary shares account. This is equity, and equity are normally credit balances. So balance brought forward that appear on the credit side. The brought forward balance for the ordinary share capital, back to the balance sheet. At the start of the year, we have 150. And then the balance carried forward. At the end of the year, we have 200 and what? We are told that we have 230. We are told that we have 230. Now, what adjustment do we need to make in this account? The only adjustment we need to make here is that note number 3, the conversion of the 10% loan stock into these ordinary shares. Now, so that we have said you decrease the loan like the balance sheet has shown. So that means you have debited the loan. Liabilities, you decrease them by debiting. So you debit the 10% loan account, and then correspondingly, you credit the ordinary share capital account. So on this credit, we'll say that we have 50. What is this? This is the 10% loan. This is the 10% loan, of course, converted. Of course, converted. We have not been told of anything else about this share capital account, and so we can balance it off. So checking on the two sides, the debit side is more at 230, and so the credit will also have 230. Realize that we therefore have a debit balance. We therefore have a debit balance. Now this will be a balancing figure of 230 minus what? Minus 150 and then minus 50. That's 30. And so that somebody very quickly, what is this 30 million? You know, this account being a credit balance account, anything that appear on the credit like this 30 is therefore something that increases it. What is this that could be increasing this share capital account? Actually, it can only increase by one thing, yeah? And what is this?
It's the issue of new shares.
Yeah, this is issue of new shares. And of course, because we are looking at the statement of cash flow, this must be a cash issue, a cash issue, a cash issue of new shares. This must be a cash issue, therefore, of new shares. So what is most important here, yeah? Why we are determining this thing is because later for the statement of cash flow, this will be a financing cash flow. This will be a financing cash flow. So this will be a financing cash flow. That will be a financing cash flow. And so that is it. And so that is it as far as the additional information is concerned, yeah? But remember, that is not all for the workings that we require. We do have more. We do have more. So that number six, let's compute the taxation paid. Let's compute the taxation or the tax paid. Let's compute the taxation or the tax paid. In that respect, what we will do is tax is normally a liability, yeah? So proceed to prepare an account for the tax liability account. Proceed to prepare an account for the tax liability. So being a liability, again, it's a credit balance. On the credit, we start with the brought forward. We start with the brought forward. Now looking at the balance sheet, the liability, you find that under the current liabilities. When you look at under the current liabilities, there is an item which the question calls the income tax payable. That is the tax liability. And at the start of the year, somebody, how much is this? Somebody? The income tax payable, how much
34.
is it? Yeah, that's 34, which we on the debit compare with the balance carried forward. And this we are told in the balance sheet that this is 19. Let me just make this clarification, yeah? That sometimes you may have two tax liabilities. One is a non-current liability, and then a second one still is a current liability, yeah? The non-current liability for tax would be what we call deferred taxation. If you remember the topic IS-12, income tax in your financial reporting, we do have two types of taxes. One is the deferred, another one is current. The deferred is normally a non-current liability, whereas the current, remember, is a current liability. In that respect, you would have two liabilities for this taxation, in which case you'd be expected to combine the two taxes to come up with this brought forward figure and this carried forward figure. So fortunately, in this case, we just had the current liability. The only other adjustment that therefore we will require for the tax liability account is go back to the P&L, yeah? Go back to the income statement for the current year. Did we have a tax expenditure for this year? Because in an income statement, we must have the tax expense for the current year. So did we have a tax expenditure for the current year? Somebody?
Yes, 47 million.
Yeah, so yes, we do have. Yes, we do have. When you check the income statement after profit before tax, there is a income tax expenditure, and that we are told is 47 million, yeah? Now, what accounting entry do you pass for a tax expenditure as you then take that to the P&L? You know, in the P&L, all expenses in the P&L, all expenses we do debit them. In the P&L, all expenses we do debit them. So with that tax expense in the P&L, we have debited the P&L. So we have debited the P&L. Expenses are debits. So you debit in the P&L. Correspondingly, we credit this tax liability account, yeah? And say that this is 47. This is 47. This is what has been recognized in the P&L. So narration, I say that P&L, maybe dash tax expense. So P&L dash tax expense. If that is the case, then of course we can balance off the tax liability account. So we find out which side is more. And it's obvious that the credit side is more at a total of 34 plus 47, that's 81. And so the credit side also will have that 81. We can then again look for what we are interested in. That is the balancing figure, yeah? And this will be 81 minus 19. Minus 19. So we end up with a balancing figure, which is 62. So that somebody, what is possibly this 62? Or just before that, yeah? We started the year with a tax liability of 34. During the year, we incurred more liability, more tax expenditure, 47. So in total, we ended up with 81. If we then close the year with 19, you know, it means we have decreased the liability, yeah? When would the liability decrease? When you have done what? Someone. When what have you done?
You've paid it.
When you paid.
When you have paid cash. So the 62 is therefore the cash paid for the tax liability, yeah? Now what's important again, later for the statement of cash flow, this will be adjusted for under the operating cash flows. So that will be adjusted for under the operating cash flows, yeah? All right. Next is number 7. Number 7, And so we shall do the same thing. We shall do the same thing, yeah, that we've done for the tax. We shall do for the interest. We shall do for the interest liability. We shall do for the interest liability. So that being a liability, again, it's a credit. And so the balance brought forward, you credit it. How much is the brought forward balance for the interest liability? Look at under the current liabilities, the interest are payable. At the start of the year, we are told we have a 3. And then, of course, the carried forward figure on the debit balance carried forward, we are told that we have how much? We have 7. You shall again look at the P&L, yeah? Because there must be an interest expenditure in the P&L. In a P&L, interest is what alternatively we call the finance cost. So rarely in standardized financial reports will you in a P&L see interest expenditure. Rather, the accounting terminology for it, we have what we call the finance cost. Again, being an expenditure, we must have debited the P&L, and so correspondingly, we credit interest liability account, where I'll say that recognized in the P&L as an expense, we have how much? How much was the finance cost? Somebody? How much was the finance cost?
17
million.
Yeah, so that is 17 million. And if that is the case, I'll have 17 million here. There being nothing else, we balance off the account to determine how much interest we paid in cash. So you realize that again, for a liability, the credit side is more at a total of 20. And so the debit side will also have what? 20. Our interest is on the balancing figure. And this will be 20 minus 7 minus 7. So we get 13. This is therefore the interest paid in what? Paid in cash. That is therefore the interest settled or paid in cash. So later for the statement of cash flow, this like the taxation, we will adjust for under the operating cash flows. So that is there any question to that point? Is there any question to that point? No question? So maybe one or two more accounts to look at. One or two more accounts that I would love we prepare. Yeah? Number 8. I want you guys to go back to under the non-current liabilities. Yeah, go back to under the non-current liabilities. We have looked at the PPE. The intangible assets have also changed. Why would the intangible assets be changing? First of all, the change is from 50-year start to 40-year end. Yeah, those assets have decreased. Now, very quickly, somebody, could you remind us of why the intangible assets would decrease? What would make the intangible assets decrease? Anybody?
Impairment.
Yeah, when we have impaired them. So in this case, we shall say that we have impairment of intangible assets. This one, we don't need to prepare an account for it. How much is it? How much is that impairment? A decrease by how much? 10, yeah? And so what is important is that where we adjust for the depreciation expenditure, we shall adjust for this impairment. So this will be an operating. This will be an operating cash flow. So that will be adjusted for under the operating cash flows. Let's go to number 9. We go to number 9. And what does number, or rather the next working, what should this be? Still under the non-current assets, we have that last asset called the financial assets through OCI. You realize that that has also changed. I think for that we can prepare an account. For that we can prepare an account. For that we can prepare an account. And I'll say that these are financial assets through financial assets through OCI account. Being an asset, that's a debit. And so the balance brought forward, we debit it. The balance brought forward, we debit it. And then the balance carried forward, we credit that. The brought forward balance was how much? At the start of the year, we had 10. Carried forward at year end, we have 22. We have 22. So this asset has increased. And so we need to find out why. The first thing to note is, can you look at under equity? I want you guys to look at under equity. We do have a reserve for this asset, yeah? More or less like the revaluation reserve for it. But then it's been called an equity reserve. So it's more or less like a revaluation reserve for it. The financial assets in accounting are governed by International Accounting Standard number 40. They fall under what we call investment property. And what IAS 40 require is that at every end of year, you revalue them. In which case you have to adjust their book values to what we call their fair or market values. When that happens, you more or less revalue. You more or less revalue. And so on such revaluation, you can lose or gain. You can have a surplus or a deficit, with respect to which you will then have a revaluation reserve for them. What now the question calls investment, not investment, but equity reserve for them. Now, what happened to that reserve? Let's look at it. Did the reserve increase or decrease between start and year end? What happened to it? Somebody? Somebody, what happened to it?
It increased.
Yeah, the reserve increased by how much? 2 million, yeah? When you have an increase, what happened? You know, that means when
You debit the financial assets through other comprehensive income accounts.
so when the reserve increases, you need to increase that asset account. Like now to increase these financial assets in value, we debit with the 2 million. We say that this is through the equity reserve. In this case, we are talking about increase in that reserve. We have not been told about anything else about these assets. And so that is it. We find out what is the other change. And for the statement of cash flow, is that cash related? So the credit is more at 22. The debit will also have 22. Our interest is on this balancing figure. And the balancing figure is how much? 22 minus 10 minus 2. That's 10. So let's again appreciate that this being an asset, anything that you debit in it is something which increases it. What is this that is possibly increasing these assets in value? What is this? Somebody?
That's cash
Acquisition, right? So this must
yes.
be a cash purchase. We did acquire more of these assets this year. So these are cash acquisition. Now, what is most important is later on for the statement of cash flow, this will be an investing. This will be an investing cash flow. All cash acquisition of assets and cash disposals, they fall under what we call the investing cash flows. So whenever you have acquired any asset in cash or disposed any asset in cash, then such cash we do classify under the investing cash flows. Let's look at what else can we work out. What else can we work out? Let me just see, give me a minute. Now, what else we can work out is let's look at the account for the retained profits account. Let's look at
sorry. What about the item gain on financial asset at fair value at the revenue account at the income statement?
be careful, which financial asset is that? You have two types of financial assets. One, you have the financial assets through OCI, the non-current. And then when you look at the current assets, we again have financial assets. Allow me to be crystal clear on this. Any change in the financial assets are considered non-current, do not appear in the income statement. The only change in the financial assets which can appear in a P&L are the changes on the current financial assets. Otherwise, any change in financial assets considered non-current, you treat such changes as reserves. And that is why we've had this reserve of 2 for the financial assets through OCI, which were non-current. So whenever you see a change in financial assets in the P&L, yeah, that must be a change on the current what? financial assets. So is that clear? Hello?
Yes.
All right. So let's look at the retained profits account. The retained profits account, because there is a change in it, we need to know why we have that change. And so that is what we shall analyze very shortly. Yeah? All right, being equity, these are credit account, and so the balance brought forward, credit it. How much was the brought forward balance for the retained profits account? The brought forward balance was 91. The brought forward balance was 91. And then we have the balance carried forward, which in the second balance sheet, balance sheet, we are told that how much is it? We are told that how much is this? This is 121. I am looking at the retained profit account. So at the start of the year, it is 91. At the end of the year, we have 120, 121. So why do we have that change? The first thing that obviously makes this account to change is if you go back to the P&L for the current year, we made some profits for the year. And the profit for the year, the final figure in that P&L, not we are told that we have 67. Normally, what makes the return profits change? The first thing that makes the return profits change is the profit that you have made for the current year. And that normally increases the brought forward balance. So you credit and say that we have 67. Where is this from? This is from the P&L. Because this is the most obvious item that makes the account change, then I want to think that that's it, unless the question has said more about more changes, then that is it. If that is the case, then we can balance off the account, and it's obvious that which side is more credit. So that 91 plus 67, we have 158. So that the debit should also have 158. We then have a credit balance, which is 158 minus 121. What we are interested in is that balancing figure, that 37. And who remembers what this is? You know, this, being that these appear on the debit of the returned profits, this must be something that decreases it. You know, the return profit we are saying is a credit balance. Anything that debits it is something that decreases it. So somebody, what could this be?
Those are dividends paid in cash.
Yeah, so this must be cash dividends. The cash dividends. The cash dividends. The cash dividends paid. And so again, later we have to remember, you have to remember that the cash dividends paid are adjusted for as which cash flows? As financing. As financing, this will be a financing. This will be a financing cash flow. That will be a financing cash flow. All right. Which other adjustment would be important for us? Possibly, I think probably number 11 and last, because we'll need this later. let's determine the cash and cash equivalents, the cash and cash equivalents brought forward and what? And carried forward, because we'll need this later. The cash and cash equivalents normally comprise what and what? Let me just be very clear on this. This normally comprises cash in hand. It also comprises cash at bank. It also comprises bank. Remember, including a negative bank balance. That's more like the bank overdraft, the OD. And also, this includes the financial assets. This includes the financial assets, but the financial assets here have to be current, the current ones, not non-current. The non-current are long-term investments, and so they cannot be considered cash equivalents. So any financial asset which is current, that's normally an example of what we call cash equivalents. Yeah. So cash equivalents are not cash, but then they are short-term investments which one can easily convert into cash. In other words, you can easily sell them so that you receive cash. So in this respect, we'll say that we have the balance what? I want to have a column for the balance brought forward, and also have a column for the balance carried forward, and also have a balance for the carried forward. Now, which of these items do we have in this question? When you look at under the current assets, we have cash. We have cash is the first one. The last current asset, the cash and cash equivalents. The brought forward balance, we have how much? We have 0. And then the carried forward balance, we are told that we have how much? 29. And then in addition to this, under the same current assets, you know, we have the financial assets. We have the financial assets at fair value. These ones are current, and so they are considered cash what? Cash equivalents. At the start of the year, we have 30. And then at the end of the year, we are told we have 60 what? 65. You also check whether you have bank. But remember, for bank, it need not be positive. You can have negative bank. So that under the current assets, we have not seen it, but check under the current liabilities. Under the current liabilities, the first item we have bank overdraft. We have bank overdraft. And so we'll say that another cash and cash equivalents is the bank overdraft. The brought forward balance for it. The brought forward balance for it, we have 22 million. Now, a bank overdraft must be a negative. That must be a negative. And then we look for the carried forward for it. The carried forward for it, how much do we have? We have not been given anything, so that's a 0. That's a 0. If that is the case, then we can get their totals. We can get the total for the brought forward cash and cash equivalents, and also get the total for the carried forward. So that the total for each, this will be +8, and then 94, which is a plus, which is a plus. With that, we can then proceed to prepare our statement of cash flow. That we can then summarize our statement of cash flow. But just before that, I'm forgetting one thing, yeah? Just before that, I am forgetting one thing. Somebody had raised, when you go back to the P&L, there was the gain on financial assets at fair value, yeah? Which was added to the gross profit. Now that was 5 million. Please remember I said that these ones relate to the financial assets which are current in nature. So it must be about, they must be about these financial assets at fair value, which I have put here. So what I'll do, so that I adjust for this separately, I will fix it as part of this, so that I will add a row, I will add a row, I will add a row, and say that on these financial assets at fair value, there was gain. There was gain. That gain is the one that we have in the P&L. That gain is the one that we have in the P&L. Now the gain is how much money? We are told that is 5. So let's agree. Let's agree. When these assets gain value, the gain in value, we do add it to what? We do add it to their figure brought forward. So that the brought forward financial assets, we had 30. When we adjusted them to fair value and they gained value by that 5 million, then that increases their balance what? Brought forward. So under this brought forward, then we shall say that we have how much? 5. If I do that, then that's what I get. The brought forward figure is there for 13, and then the carried forward figure is there for 94. So with that, we have completely adjusted fully for the financial assets and their gain, which was in the P&L. So with that, what we can do very quickly is to then summarize what the question wanted, yeah? To then summarize what the question wanted, and that is the statement of what? Cash flow. So we must start with the title, remember? And the name of the company, we have Bermuda, yeah? Bermuda Limited. For any financial report that you prepare, please start with the title, yeah? So Bermuda Limited. This is the statement. This is the statement of cash flow. Of cash flow for the period 2. For the period 2, this is the period to which year? 30th June. 30th June. Now this is 2022. So that for a statement of cash flow, you need 2 columns for the amount. You need 2 columns for the amount. We have shillings in millions. And then another 2 columns for the amount. Excuse me. All right, now remember we separate the statement of cash flows into 3 sections. The first section is what we call the operating. So we start with the operating cash flows. We start with the operating cash flows. And under the operating cash flows, allow me to also explain this, that we should normally start with the profit before interest and taxation, yeah? But normally interest is part of the normal expenditure, so that you minus interest from profits before you can compute tax. So you normally minus interest as one of the expenses before, or for you to get the profit before tax. So the only profit we have before something in our P&L is the profit before taxation, but which is after interest. So start with the profit before taxation. We shall then proceed to adjust for the interest thereafter to make it a profit before interest and taxation. When you look at the P&L, yeah, how much is the profit before tax? When you look at the profits, when you look at the P&L, how much is the profit before taxation?
114 million.
Yeah, we are told that is 114. So that's what we start with under the first amount column. So that we then proceed to adjust for, on this PBT, adjust for the non-cash, and the non-operating items. Adjust for the non-cash and the non-operating items. Adjust for the non-cash and the non-operating items. Now, this is what we said, yeah? That so this is what we said, that we should start with the profit before both interest and taxation. But as we started with the profit before tax, which is after interest, now we need to make an adjustment for the interest. For the interest is the finance cost. The finance cost, so that we make our profit be profit before both interest and taxation. What do we do with the interest or the finance cost?
We less.
We minus. We already minus that before. Do we minus again? Really?
Add it back.
Yeah, you add it back. Add it back. So add back the interest so that your profit is now profit before both interest and what? Taxation, yeah? Now, which are the most obvious non-cash items to adjust here? Somebody?
Depreciation.
Depreciation is the first. So being that we already minus the depreciation as an expenditure, then you add back the depreciation expense. How much was the depreciation expense? So this was this 43.
43.
So you add back. What else? What other non-cash item? Somebody?
Impairment.
There was impairment. There was impairment. The impairment
of 10 million.
we did compute. And in that case, you can refer to, we had that in working number 8. This impairment of 10. Note that like depreciation, that also you add back. So that also you add back. Now somebody, what other non-cash item do we have?
Loss on disposal.
There was loss on disposal. There was loss on disposal, yeah, which we had in working number 1 as 6. But the question gave us that directly. So I said if a question does not give, then you have to evaluate the disposal and find out whether you gained or lost when you sold whichever asset. Yeah. So loss on disposal also that you add back, that's a plus. If it's a gain, then a gain is a negative. Yeah. So the loss is a plus. Now, what else? What other non-cash or non-operating item do we have here? When you go back to the P&L, added to the gross profit, we have two things. There are two items added to the gross profit, so that another non-cash is that gain thing. Another non-cash is that gain. The gain on what? On financial assets at fair value. Because when you are told they gained, that gain was simply through their evaluation. That gain was simply through revaluing them. If that is the case, you know, revaluation is an item which is purely non-cash. So that's non-cash. And so, you know, again, you added to the profit. So you minus. But again, you added to the profit. And so we minus. Now that's a 5. That's a 5. So that's a 5. And then also now after that gain on financial assets, you know, we have investment income. Now the investment income is an item which is cash. That's an income which we receive in cash, but you realize that is it operating really? Investment falls under investing cash flows. So that should come under the next category of cash flows, the investing. So because this one is non-operating, then you have to remove also, minus also the investment, now income. So this one is not non-cash. This one is cash, but non-operating. This one is cash, but non-operating. So we minus here, but later under the investing cash flows, we add them back. Later under the investing cash flows, we add them back. So this one is a 6. This one is a 6. I do not think that we have anything else. And so that is it. And so that is it. If that is it, then we proceed. We proceed to add them. If you add them, we add them from 114 downwards. We get a total sum of 179. At this point, we know that we introduce the changes in working capital. So working capital changes. Now, you know, for the working capital, we have just 3 things: the receivables, payables, and inventory. So the inventory, the receivables, and then payables, those are the working capital. When we talk of their changes, we mean their increase or decrease between year start and year end. Let's start with inventory. Between start of year and year end, did the inventory increase or decrease? Between
Decreased.
Inventory decreased. So we shall say that the change is a decrease. Decrease in what? In inventory. And the decrease is how much?
53 million.
How much is that decrease?
$53
million.
That's a decrease of 53 million, yeah? When inventories are decreased, is it a cash inflow or is it a cash outflow, yeah? Is it a plus or is it a minus?
cash inflow.
Yeah,
A plus.
it's a plus because inventories decrease when you have sold them, yeah? So decrease means sales. That's a cash inflow. So it's a plus of 53. Let's go to receivables. Let's go to receivables. Did the receivables increase or decrease?
It increased.
Yes,
There was an increase.
there was an increase in receivables. So we say that increase in receivables. In receivables, and the receivables increased by how much?
By 8 million.
By 8 million. And when receivables increase, what's the interpretation? Is that a plus or a minus?
That's a minus.
Yeah, when assets increase, it's a minus. When assets increase, that's a minus. Lastly, can you check on the payables? Did the payables increase or decrease?
Increase.
Yeah, the payables increased by how much? The payables increased by how much?
56.
By 56. And when liabilities increase, it means you have saved cash, you have retained cash, and so that's a plus. When liabilities decrease, it means you have paid for them, so a decrease should be a minus. That is it for the working capital changes. We then add them downwards from 179. We then add them downwards from 179. We then add them downwards from 179. We get a total of 280, a plus. And then at this point, you must always minus two things. One is the taxation paid, and then number two will be interest. Interest also paid. You will always minus those two things. Taxation paid, and then followed by interest, what? Interest paid. So the taxation paid, we had computed how much. There was a working for it. Remember, it's this working number 6. Working number 6. Being a payment, that should be a minus. So I'll say that equal to minus this 62. Tax paid was 62 in working number 6. And then interest paid in the same manner. So equal to minus what? Equal to minus 13. I want them as negatives. So as I copy, I put a minus before I copy equal to minus. Then I copy the figure. If that is it, then again we can add them. And if we add them, we get the net operating. We get the net operating cash flows. We get the net operating cash flows. And the net operating cash flows are, this is how much. Remember that now comes under the second amount, under the second amount column. So under the second amount column, so equal to sum of all these 280 and the other two payments. We end up with the 205, a plus. So we end up with the 205, a plus. we end up with 205, a plus. So we end up with 205, a plus. So that's it for the operating cash flows. The next category of cash flows are the investing. So we go to the investing cash flows. We go to the investing. We go to the investing cash flows. We go to the investing cash flows. The investing cash flows are which cash flows? By summary, these are majorly two cash flows. One is any cash we spend to acquire the non-current assets. Any cash you spend to buy any non-current asset. And then secondly, any cash you receive when you have sold or disposed a non-current asset. And I want to believe that we have computed cash acquisitions. Cash acquisition, number one of PPE, cash acquisition, number one of PPE. And how much PPE did we acquire in cash? I'll say that equal to negative what? The PPE acquired in cash was in working number 2. Working number 2, we computed 165. Please note that that's a minus because that money we have paid out. So that's a minus. There was also cash purchase. There was also cash acquisition of the financial assets, You know, we had called them the financial assets through OCI, of the financial assets through OCI. And in this case, we had said we had acquired how much? The financial assets through OCI was working number 9. If you refer to working number 9, we computed the cash purchase as 10. So again, we'll have negative 10. So that should be a negative. So equal to minus 10 equal to minus 10. We do not have anything else that we acquired in cash, but there is also cash from disposal. There is also cash from disposal, which was in that was in working number what? Refer back to working number 3. Cash from asset disposal, we computed this 22. And being money we receive, that's a plus. Being money we receive, that's a plus. Being money we receive, now that's a plus. The last investing cash flow will be what we had removed under the operating cash flows. That is the investment income. So we remove under the operating because it is non-operating. It is investing in nature, and so we bring it under the investing cash flows. Yeah. So we had minus under the operating cash flows. We add back under the investing cash flows. So you add back. If that is the case, I want to believe that that is it for the investing cash flows. We can therefore get our net investing, cash flows, our net investing cash flows, so that again that figure will appear under the second amount column. So I'll say that equal to the sum of all these. So it's a total of 147, a negative 147 are negative. The last category of cash flows, we then have financing cash flows. The financing cash flows. The financing cash flows. The financing cash flows are which cash flows? Any cash flow to do with raising finance. Any cash flow to do with raising finance, maybe through borrowing, through issue of shares, and so on and so forth. Yeah. And then all cash flows are to do with, of course, rewarding the providers of finances through something like dividends, or repaying a loan repayment. Yeah. The first one we have seen that there is cash from what? Cash from issue of shares. Cash from issue of shares. And I want us to agree, the cash from issue of shares is in this working number 5. When you look at the ordinary share capital account, yeah, working number 5, the cash from issue of shares, we had computed how much? This 30. But this is normally plus what? This is normally, you must check the share premium account. Go back to the question and check on the share premium. Check whether did the share premium change? Did the share premium change? Because if you had issued shares, there is a possibility that you issued at a premium. Did the share premium also increase, just like the share capital increased? Somebody check on the share premium and equity.
Yes, by 30.
Yeah, the share premium also increased by 30. Yeah. So we not only issue the shares, but also there was a share premium for this issue. Now allow me to clarify on this working number 5 that the share capital account is normally recorded at par value, so that whatever issue you get in the ordinary shares account, you get that at the par value. In case there was share premium on issue, you can only see that in the share premium account. Yeah, that's why you have to counter check the share premium and get any possible premium on this issue that we are now convinced we did have. So the total cash from our shares issued, therefore, will be this 30 for the ordinary shares at par. I will say that plus for the share premium, another what? Another 30. For the share premium, another 30. So that's a total of what? 60. And that's a plus because we issued the shares, and so we are receiving money. What other financing cash flow do we have? There was cash dividend paid. There was cash dividend paid. The cash dividend paid was in which working? The working for the retained profits account. Now that was working number 10. When you check working number 10, we had computed a cash dividend paid of this 37. So I copied the 37, but that's a payment, and so that should be a minus. So before the sale, I'll just put minus. I'll just put minus so that we have negative 37. So that we have negative 37. Was there anything else? Did we say we have another financing cash flow?
Loan stock.
The loan stock, I do not think there was cash with respect to the loan stock, yeah? You know, the loan stock, we did convert it into ordinary shares, yeah? If you look at this ordinary shares account, we have the converted loan of 50 million. So that is right. You must always check on the loans and check whether if you have an increase, whether you borrowed more loan, in which case you receive cash, or check whether you have a decrease, in which case technically you normally have a loan repayment. But then we have confirmed that the decrease in loan stock is not because of a repayment. The decrease in the loan stock was because of this conversion. This conversion, that's not cash related, and so it cannot now come here. I want to think that that's it for the financing cash flows. Yes, Maureen, you have raised up your hand.
Oh, I have a question.
Yes.
How did you get 60 from cash, your cash issue of new shares? It was 30.
It was 30 for the ordinary shares at par, yeah? When you check the share premium, please check the share premium. Did the share premium change? When you check the share premium, it also changed by 30. So that means we issued shares at a premium. The 30 in the share capital is the par value of that issue. So in addition to the par value on issue, there is also normally the possibility of the issue having happened at a premium. So there's the cash for the share premium. So when the share premium has also increased by 30, then the issue happened at 30. So 30 for the share premium plus 30 for the ordinary shares at par gives you that 60. Is that okay?
It's okay.
Let's get the net financing cash flows. 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 And this will be equal to the sum of these two. And so we get plus 23. Because that is it, then we can compute the cash and cash equivalence change for the year. That is the change in cash and cash equivalence for the year, so that the change in cash and cash equivalence for the period is a summation of these three cash flows in the second amount column. You know, in the second amount column, we now have three figures. One for the net operating, another one for the net investing, and another one for the net financing. So when I add the three, I end up with a total of, just a minute. So I end up with a total of, so 205 plus minus 147 plus 23. We end up with 81. So we end up with 81, yeah? That is the change in cash and cash equivalents for the period. At that point, we introduce the cash and cash equivalence brought forward, so that we can have cash and cash, equivalence the carried forward. The cash and cash equivalents brought forward and carried forward, we already have them, yeah? Remember, we have already computed that in this working number 11. When you look at this working number 11, the brought forward we said is a total of this 13. The carried forward is this 94. So you'll check whether this reconciles. If the brought forward we are saying is 13, Do we get the carried forward of, so the brought forward we are saying is, let me just say equal to, I copy from here 13, and then carried forward is equal to, I copy from here this 90, 94. We had already determined all that, yeah? And by the way, you must make sure that they do reconcile. You must make sure that they do reconcile. If I take the change for the year, I add to it the brought forward figure, yeah? Do I get the carried forward figure? Somebody confirm to us whether those two reconcile. Do they reconcile? Somebody?
Yes.
Yes.
All right. Thank you very much for the confirmation. So it seems like most of you are learning with the children today. Once you unmute to say something, I can hear children all over. So they are reconciling. Of course, for you in exams, this will be very difficult to do. Do not focus on balancing that thing, yeah? Focus on having most entries correct. This question is marked on a per entry basis. The question is marked on a per entry basis. Every correct entry has a mark all the way from this PBT. Every correct entry has a mark. So focus on having most entries correct. Don't focus on balancing because you won't, yeah? You won't. Is there any question?
No question. We appreciate you for this. Thank you.
He's muted.
Thank you.
All right, so is there any question? Somebody? Is there any question?
We just want to say thank you, Mwalimu, for taking your time and taking us through this. We appreciate so much.
Yeah, thank you very much, Nani Jabayo. Now I want you guys to give me about 10 more minutes. I hope that will be okay with you people. Just 10 more minutes. Is that okay?
Okay.
Are you guys
Yes, it's okay.
okay giving me 10 more minutes?
Yes, it's fine.
I'm sending to your WhatsApp group something. I'm sending to your WhatsApp group something. Yeah, so then there's an Excel that I have sent to your each of your WhatsApp group, an Excel titled an Excel titled common size reports and ratios. Yeah, common size reports and ratios. So again, I'll send to your WhatsApp group that working for the cash flow. I'll send that Excel, and the video will also be available. So those who want the video, you let me know through the WhatsApp group if you want the video for this class. The video will be available. Yeah. So I'm sharing that Excel. I'm sharing the Excel for the cash flow. Otherwise, open that other Excel which I've sent. Yeah. All right, so I have just shared through your WhatsApp groups the solution to the cash flow. And so allow me to proceed to that next Excel, which I've just sent. So don't worry, I'll make it very brief so that I do not take much of your time. Yeah. Now, just to share the Excel here. Marion Mukami, you are saying the Excel is not opening on your side. Check on your network and search. It should be opening. It should be opening, yeah. Check on your network, most probably. Can the others confirm that you have opened the Excel? Any confirmation?
Yeah.
Yes, we are.
All right. So Marion, or yeah, this is Marion. Marion Mukami, please check on your network. I believe it should open. It's just a mere Excel file. Mere Excel file, yeah. Now, that Excel has 2 sheets. That Excel has 2 sheets. One is what is titled the common size reports, and then what we call what I've called ratios. The common size reports and the ratios are what in accounting we call methods of financial statements analysis. They are methods of analyzing financial statements. So they are methods of financial statements analysis. If you want to analyze financial reports, and as an accountant, you have to know this, that you can break down financial reports into number one, what we call ratios, and then number 2, common size, yeah, common size financial reports. The 2 are ways of analyzing, understanding in depth your general financial reports. You know, most of the times when we prepare financial reports, we prepare them in general. We prepare them in general, meaning you cannot gain deeper understanding of these financial reports until and unless you do what we can call further analysis. And further analysis will mean breaking down the financial reports into more refined info, easier to understand. And this we can do through number 1, ratios, and then through number 2, common size financial reports. Now, this is the thing, yeah? The ratios should not be problematic per se, because we have come across ratios in earlier studies. What is important for the ratios, like now when you go to that sheet number 2, when you go to the second sheet, I have summarized for you the various ratios formulae. The various formulae for various ratios, I have summarized them for you. You may not be in a position to know all, but I will advise that know most of them, especially the most obvious ones. So it's a topic which I'll not pick and of course start calculating these ratios very directly, because once you know a formula, then that's it. It's about applying the formula to then calculate the various ratios figures. Now, for you to then be able to understand the interpretation of each and every particular ratio, I will share another PDF, yeah, another PDF document for the ratios, another PDF document for the ratios to your WhatsApp groups, so that you can get a little bit of backgrounds for each ratio and then interpretation for each ratio. But I believe what is first and most important, do you know the formula and can you compute it? The interpretation is normally a very simple part of this exercise. So what you need to know are the formulae and then be able to apply that formula to actually compute compute a ratio. So let me very quickly share a PDF. It's a very small document, about 3 pages, with the theory versions of these ratios, and of course this formula that I've summarized, and the possible interpretation for each type of ratio. Yeah, so that I'm sharing to your WhatsApp group very shortly. So I have just shared to your various WhatsApp groups so a fantasy is asking, is a consolidation question a probable question in BDA exam? Yes, it is, and we shall cover that. Yeah, worry very less about it. What you need to be reminding yourselves about is the rules of doing consolidation, the rules of consolidating parent subsidiaries, associates, and joint ventures. We shall cover that. Don't worry. Within the next one lesson, I believe we'll cover that. Yeah. So worry less about it. Yeah, so let's now bring ourselves to speed on what the common size financial statements are. Yeah. Who's come across the common size financial reports? I'll make this very brief. Be sure that at most 10 minutes thereabout, 15 minutes thereabout, we are done with this. Yeah. Who's come across these financial statements before? Is there anyone who's come across them? They are not very common. So remember, I've said that apart from our use of ratios to do financial statements analysis, we have what we call the common size financial reports, which also are for analysis. Who has come across them? Seemingly no one. So they are new to most of us, if not all, yeah? But these are simply financial statements prepared together with, let me call them percentage, let me call them percentage ratios for each line of item in the financial report, in the financial statement. That means that if it is something like what? If it is something like, you see now, like in this question, we are given a statement of profit and loss, yeah? Let me hope you can see my screen. If it is something like this statement of profit and loss, we not only as normally show the values for the various lines of items, but then for each line of item, additionally, we show a percentage ratio. Very shortly, I will illustrate that. And then what happens is that to be able to compute the ratios, to be able to compute or determine the ratios, the percentages, let me call them the percentages ratios, the following bases are applied. The following bases are applied. Now for the income statement, let me say that the base for the income statement, the base for computing the percentages is the revenue or the sales figure. You use revenue or the sales figure. And then for the balance sheet, the base is normally the total assets figure. So the base is normally the total assets figure. The base is normally the total assets and so that of what importance are the common size financial reports? What is their importance? Now, both of them are used for comparison, or rather, they are used for comparison. One is to compare two or more companies to determine, to compare two or more companies, to determine which is best, to determine which is the best one, to determine which is the best one. And then you can also use them to compare for the same company, to compare for the same company, two or more accounting periods, to compare two or more accounting periods. Those are the importance of the common size financial reports. You see, like, let's go through this illustration. Read through that illustration and see what the question wants us to do, in which case we shall illustrate these common size financial statements. Yeah, so read through that information. Yeah, so look at what the question require. Yeah, that number one, we prepare common size statement of profit or loss for the two entities for the financial year ended 30th April 2022. Number two, common size statement of financial position. And then number three, advise the directors of Dragon Limited on the best company for takeover. Yeah, so the directors were torn between whether to take over company Able or company Cedar. Yeah? And so they want to use the common size financial report to do this, to decide on whether is it company able or is it company CDA that they then take over. For this reason, we are told that in number one, we prepare the common size. We prepare the common size income statement. We prepare the common size income statement. And so what I'll do is I'll copy the information. So remember, in exams, your exams will come, the section 2 will come in terms of the section 2 will come in terms of an Excel. So you'll just be copy pasting, nothing like typing anything. So I'll just copy paste. And then what has the question given us? We have the first company able. And then we have the, so able, so I'll compute for able the percentages. The percentages are what we are looking for. And then I'll have the second company CDA. So again, for CDA, I'll compute the percentages. So the figures we are given for these two, again, we can copy them. The figures we are given for these two, again, we can copy them. So I'll just copy the exact income statement. And then for CDA, I will do the same thing. I'll just copy the income statement for CDA. So for the common size financial statements, we prepare the normal financial report, yeah? We prepare the normal financial report, but besides it, we accompany that with a percentage ratio for each and every line of item in the report, yeah? Like now for this P&L for company CDA, for each of these items from revenue all the way to the profit for the year, yeah, we compute a percentage ratio. Now this is what we have said. For us to be able to determine the percentage ratios, there must be this thing that we have called the basis of calculating that ratio. So you must refer to that. And we have summarized that for the income statement, the base is normally the revenue or sales. So that means that we express as a percent every item here as a percentage of this total revenue figure. If I start with the revenue itself, yeah, if I start with the revenue itself, the percentage for it will be this 87.5. I will divide by the same 87.5. As a decimal, you get 1, but then as a percentage, that's 100%. That's 100%. So that's 100%. And so we shall do the same thing. And so we shall do the same thing for all the items to the last, for all the items from cost of sales to the profit for the year. So you take the item, like now cost of sales is 66,500. I divide by this 87,500, the total revenue figure. And so on and so forth until the profit for the year. So and so on and so forth until the profit for the what? For the year. And so on and so forth until the last figure, the profit for the year. So that way That way you can have those percentages to the profit for the year. And that's what you get. To make it easy, you can just lock in the first formula for the revenue. You can just lock the denominator. You can just lock the denominator. I hope you remember the locking that we talked about under amortization. Yeah. No. Yeah. The loan amortization schedule. We talked about the locking thing. So just lock the denominator, then drag the formula to the last item. So the same thing we can do for CEDA. I'll take the revenue for CEDA. I'll divide by the same revenue so that I have 100%, but I lock the denominator. I put dollar before the letter. I put dollar before the letter, and I put dollar after the letter. Yeah. So because that denominator, that revenue is constant throughout, then very quickly I can get those percentages. So this is now what we call a common size income statement. So apart from the tradition showing of the absolute figures for each line of item in this report, we accompany that. We show also the percentage ratio for each and every line of item in this report. So it is that simple. Is there any question on this common size income statement? Do we have any question from anyone? So what these ratios mean, is this, yeah, that if I pick, for example, for company Able, when I say that the cost of sales is a ratio, or rather is a percent of 76, what this means is that for company Able, the cost of sales accounts for up to 76% of the total revenue figure. That is what that means. If I go to company CEDA, the cost of sales accounts for up to 82%. You know, that means that the costs in CEDA is therefore more than the costs in who? In Able. Look here. If you check the absolute figures, they can be misleading. They can be misleading. So to really confirm, yeah, is to then compute their percentages out of that base. The base is revenue. So if for Able cost of sales account for 76% and cost of sales in CEDA accounts for 82%, then it means that Able is more now cost efficient. And that's the importance, one of the importance of the common size financial statements. Yeah. Let me then ask, on the basis of just the income statement alone, can we answer required part 2? Because required part 2 said that advise the directors of Dragon Limited on which company to take over. So let me hear from two of you. Which company is then best for a takeover? Is it Able or is it CEDA?
Able.
Yeah, Able is better, because Able seems to be better in most of the income statement line of items. So Able is actually better. Let's proceed to look at the common size balance sheet. Number two, we prepare the common size. Income statements, not income, but balance sheet. The common size balance sheets. So that I'll need the same info. The company, then percent.
Question.
Yes.
Does the examiner allow us to call it balance sheet or statement of financial position?
It is the same thing. The statement of financial position is just a modern naming for it. Otherwise, the accounting standards still allow that you call it the balance sheet. Yeah, the statement of financial position is just a modern name for it. You see, like the income statement, you could alternatively call it the profit and loss, the profit or loss statement. And that's what we've had in the past. So that currently the income statement could as well be called what? Be called the statement of financial performance. Could as well be called the statement of financial performance. So those are just modern namings for these things. Otherwise, the namings still apply. If I say balance sheet, this is still very okay. But then to make it beautiful, yeah, so that your accountants are confused the rest of the world, you then introduce these beautiful names like statement of financial position, yeah, but that is just the balance sheet. So that's okay. We proceed on, so that again I'll copy the balance sheet items. So that again I'll copy the balance sheet items. So I'll copy the balance sheet items from assets. Yeah, so that is it. What is most important is how do we get the percentages? How do we get the percentages? So how do we get the percentages? So how did we say that we get the percentages? For the balance sheet, what have we said is the base?
Total assets.
Yeah, for the balance sheet, work with the total assets figure, which is that what I have highlighted in yellow. So everything in that balance sheet you divide by what I have in yellow per company. Everything in that balance sheet divide by the total asset figure. Divide by the total asset figure, so that for example, property under company able, that 98, I divide by total assets 33.6. What I get is about 29%, yeah. And so again, because the total assets will be constant until the last item, I will just lock it and then drag the formula to the last item. So that I'll just do away with what should not be part. Don't compute percentages for those items which are not part. So the same thing will apply for CEDA. Property, the 10,500, I divide by total assets, the 66,500. I will lock the denominator. I will lock the total assets figure. And so I will drag the formula to the last item. And then again, do away with the spaces where I do not have an item of the balance sheet. And so, ladies and gentlemen, that is it for the common size balance sheets. Yeah, balance sheets. Number 3 of the question wants that we advise on the best company for takeover. We have agreed that Able is best. Able is the best. Of course, for the reason that it is better than CEDA Limited in most percentage parameters or ratios. Most percentage ratios. It need not be best in all parameters, but as long as it is best in most of the comparisons, yeah, most of the item comparisons, then it is the best. Yeah. So that is there any question on this, somebody? Is there any question on this?
Just a question, eh?
Yes.
Hello. Oh, yeah. What are the marks allocated to such a question? Assuming it's exam.
You know, it will depend on the exam, yeah? The marks for a question, you cannot, depends on the final examiner.
Okay.
They'll allocate whichever, depending on how the paper is, yeah? Marks allocated will always vary from one sitting to another, one exam to another. It depends on the allocated marks for the other questions. You know, the marks are allocated rationally for all questions. So this will vary from one examiner to another, yeah? Okay. That we cannot tell now. Are you asking that because it looks very simple for you?
Yeah, somehow.
I know that is the problem. So worry less about the marks, not the concept. That is what is then important. That is what is then important. Any other question or any other concern? Then I wish to stop there. I wish to let you continue enjoying your weekend. Sorry to be part of your Sunday on a short notice. on a short notice. Yeah. So thank you very much. Now, have I sent you guys the solution for the multiple choice part of December 2022 and April 2023 exams? Have I sent you the solutions for the two?
No.
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 Okay. Do you need them?
Yes.
Yes.
Okay.
Previously on Half and Half.
Let me just, before we leave, let me just send that
According to Miss
Right
so
Ford,
that I don't
often the
forget.
music business has
Let me just send that so that I don't have to, so that I don't forget.
And from there. Okay.
Yeah, so that's now available in your WhatsApp groups, the various WhatsApp groups. That's now available. It's what I have titled. I have titled it BDA Section 1 Solution, December 2022 and April 2023. So that is what we had used to mark the exams for December last year and April this year. Yeah. Right. Is there anybody with now? So those are the solutions for the multiple choice questions. Is there anybody with now any query, anything before we stop?
I have a question.
Yes, go ahead.
Are there notes for the multiple section?
No, the multiple section, you know, BDA is a paper that is practical. Yeah? It's a paper that are things you should be knowing before you come to really do this paper. Yeah. Like now the section 1 is about ICT, the ICT that you guys have done in a previous study in CPA. I don't know whether it's called MIS or ICT. I don't know what it's called. Yeah. So you should have done computers, you should have done Excel and such kind, yeah. So that then such should not be an issue. If you're asked about a shortcut in Excel, can you remember what you have done in Excel? That is why we have always insisted that at the start, if you've not done Excel, and it would be good that actually you know even advanced Excel a little bit, you should have gone through that course. Excel is a 1 week thing to learn, yeah. So I have tried to share some materials which you could as well be going through on that theory part. So really there are no direct notes. Okay. With the time we can develop, but as it stands now, no notes are direct. You need to remember your ICT well, your computer packages, Excel especially, both the normal Excel and of course the complicated Excel. What do you call it? Advanced Excel. Okay.
Okay.
Yeah, so I do not have a very direct question to that. Otherwise, for section 2 is pure practice. Pure practice, what we do every day on Excel. That is what section 2 is about. So get to go through that section 1. I've given you the solutions for December, and I've given you the solution for December and April. See the kind of questions that come in that section. You'll see that it purely matters ICT and Excel. Is there any other question, any other concern, anything else?
Is the afternoon class still on?
Yeah.
Is the afternoon class still on?
The afternoon class is not on. This covers that afternoon class. So relax today in the afternoon. Any other concern? Jabayo, are you okay? Any other concern? If no concern, then thank you very much, ladies and gentlemen. Good afternoon and enjoy the rest of your Sunday. God bless, and see you guys next week. Asanteni.
Goodbye.